This is ShadowQuant, Crypto Edition, brought to you by AresLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Tuesday, June 30, 2026, and this is the New York session. Now, let's get into it. Bitcoin is trapped in a liquidity vacuum. With futures demand collapsing to levels not seen since 2024 and a 700% spike in forced Iranian outflows flooding the market with unpriced sell pressure. The crypto market is facing a structural stress test that traditional technicals can no longer cushion. The Fear and Greed Index has plunged to 14, signaling extreme fear, while the VIX remains eerily calm at 18.41, creating a dangerous divergence between traditional market complacency and crypto capitulation. As of 9:19 ET on Tuesday, June 30, 2026, we are dissecting this breakdown to determine if this is a temporary liquidity trap or the start of a deeper structural shift. Before we dive into the charts, let's look at what is moving the needle right now. The most critical event on the calendar today is the U.S. Senate housing bill, which now includes a ban on a central bank digital currency. This legislative move introduces a significant regulatory tailwind for decentralized assets, potentially offering a long-term structural floor against government surveillance, even as the spot market grapples with immediate liquidity shocks.
And that's the key tension we're facing. We have a legislative narrative that supports decentralization long-term, but an immediate geopolitical shock that is draining liquidity short-term. We need to see how the market reacts to the CBDC ban news in the context of the current futures collapse.
Let's look at the broader market overview. The total cryptocurrency market capitalization has contracted to $2.11 trillion, a 1.31% decline over the last 24 hours. Bitcoin is leading the charge lower at $58,383, down 2.98%, while Ethereum holds at $1,557.59, down 1.62%. The 24-hour trading volume stands at $78.60 billion. The most striking data point here is the rise in Bitcoin dominance to 55.45%, which typically suggests a flight to safety. But in this case, it's happening alongside a collapse in institutional leverage. Let's turn to the headlines that are actually moving these numbers. First, Cointelegraph reports that Iranian crypto outflows have spiked 700% following U.S.-Israeli airstrikes. This is not just news. It is a forced liquidity event injecting massive, unpriced sell pressure into the market.
This is the primary driver of the current volatility. We are seeing a sudden, unpriced liquidity drain from sanctioned regions. The 700% spike is not organic trading, it is forced liquidation. The question is where this capital is going. If it's hitting centralized exchanges for immediate fiat conversion, we see a sharp, violent drop. If it's moving into stablecoin reserves, we might see a stabilization. Right now, the data suggests an aggressive off-ramping that is stripping liquidity from the order book.
Second, Cointelegraph reports that Bitcoin futures demand has fallen to 2024 lows. This indicates that institutional players are either pausing activity or exiting the market entirely, leaving spot prices exposed to the full force of the Iranian outflows.
This is the structural problem. The collapse in futures demand means there is no institutional bid to absorb the sell pressure from those Iranian outflows. We have a vacuum on the buy side and a flood on the sell side. This is why we are seeing such sharp declines without the usual bounce that leverage usually provides.
Third, CoinDesk confirms that the U.S. Senate housing bill includes a CBDC ban. This is a significant regulatory shift that could provide long-term support for privacy-focused and decentralized assets, contrasting sharply with the current short-term pain.
This is the only bright spot in a sea of red, but do not mistake it for immediate price support. The CBDC ban is a long-term structural hedge, but it does not absorb the immediate sell pressure from the 700% spike in Iranian outflows. The market is currently testing a liquidity trap where price discovery is broken by forced selling, not by regulatory fears. The legislative narrative is irrelevant to the mechanical stress of a 55.45% Bitcoin dominance rising amidst a 14/100 fear and greed index.
Let's start our deep dive with Bitcoin. It is trading at $58,383, down 2.98%, testing a critical structural juncture. The collapse in futures demand to 2024 lows removes the leverage buffer that typically cushions spot price action.
Bitcoin is at $58,383, and this level is being tested as a fragile support. The absence of futures leverage creates a liquidity vacuum, meaning spot orders must absorb all sell pressure without the dampening effect of long positions. The technical setup is defined by this fragility. We are seeing classic capitulation characteristics, rising Bitcoin dominance alongside severe underperformance in high beta alts. The $58,000 level is not a floor, it is a breakdown zone in a vacuum.
Grid is correct about the vacuum. With Bitcoin futures demand at 2024 lows, there is no institutional catch to stabilize the price. The on-chain data shows a structural deficit in institutional leverage. The 700% spike in Iranian outflows is targeting centralized exchanges for immediate conversion, and with no futures buyers, the spot market is exposed to the full force of this sell side.
The sentiment confirms the technical breakdown. The fear and greed index is at 14, which is extreme fear. The 7-day trend has risen from 12 to 14, indicating that panic is accelerating. Retail traders are exiting speculative assets like Dogecoin, which is down 4.3%, while institutions are pausing. The combination of extreme fear and rising dominance suggests that any bounce will be met with immediate selling pressure. Moving on to Ethereum. Ethereum is at $1,557.59, down 1.62%, showing relative resilience compared to Bitcoin's minus 2.98% decline. This creates a temporary divergence that may attract short-term mean reversion trades, though the macro backdrop remains hostile.
Ethereum is holding at $1,557.59, significantly outperforming Bitcoin's minus 2.98% decline. This relative strength suggests that Ethereum may be a safer technical hold than Bitcoin in this specific risk-off regime. However, the 24-hour high of $1,630.03 and low of $1,553.58 indicate that the asset is struggling to maintain momentum above $1,600. The divergence is real, but it is fragile. If Bitcoin breaks below $58,000, Ethereum will likely follow, albeit with a slight delay.
The flow data supports this relative strength. While Uniswap has dropped 6.54% and near 4.89%, Ethereum is holding up better because it is less correlated to the speculative layers that are being punished. The decentralized finance sector stress is evident in Uniswap's decline, but Ethereum's utility narrative is providing some support. However, the total market cap contraction of $2.11 trillion suggests that the liquidity shock is broad-based.
Apex here. The divergence between Ethereum and Bitcoin is interesting, but we must be cautious. Grid flagged the relative strength, but CIPHER noted that the liquidity shock is broad-based. The lack of futures demand across the board means that even Ethereum's resilience is under threat. The market is in a liquidity trap, and no asset is truly safe until the Iranian outflows normalize.
Let's look at Uniswap. Uniswap is down 6.54%, trading at $2.77, the largest percentage drop among major caps, indicating severe stress in the decentralized finance sector.
Uniswap has broken key psychological levels at $2.77. The breakdown pattern is clear. The sell-off is not just macro-driven, it is actively destroying technical structures in speculative layers. The 24-hour high of $3 and low of $2.76 show that buyers are absent. This is a classic breakdown in a high-beta asset.
The decentralized finance TVL is contracting. Uniswap's 6.54% drop signals that users are moving capital away from high-risk protocols. The on-chain data shows a direct correlation between the geopolitical shock and the outflow from decentralized finance. This is not a temporary dip. It is a structural shift in user behavior.
Sentiment in the decentralized finance community is deteriorating rapidly. The 6.54% drop in Uniswap reflects a loss of confidence in speculative layers. Retail traders are abandoning these assets in favor of safer stores of value. The fear is palpable, and the 14/100 Fear and Greed Index confirms that this is a capitulation event. Next, let's look at Solana. Solana is at $72.26, down 2.35%. As a high beta proxy for risk appetite, it is underperforming Ethereum, reflecting the broader risk-off rotation.
Solana is at $72.26, testing the lower bound of its recent range. The 24-hour high of $75.93 and low of $72.05 show a clear downward trend. The lack of volume support suggests that this decline is driven by forced liquidations rather than organic selling.
The flow data for Solana shows a significant outflow from staking protocols. As risk-off sentiment increases, users are withdrawing from high-yield positions. This reduces the effective supply of Solana on exchanges, but the sell pressure is overwhelming the buy side. The 700% spike in Iranian outflows is likely impacting Solana as well, given its correlation to risk assets.
Retail sentiment for Solana is weak. The 2.35% decline is part of a broader trend of capital fleeing speculative layers. The community is reacting to the geopolitical shock by reducing exposure to high beta assets. The 14/100 Fear and Greed Index is a strong indicator that this trend will continue until sentiment stabilizes. Finally, let's look at XRP. XRP is at $1.03, down 2.7%. Unlike most other assets, XLM is the only major cap in positive territory, up 0.87%, highlighting the distinct utility narrative that is currently attracting capital.
XRP is at $1.03, and the 24-hour range of $1.07 to $1.02 shows a tight consolidation. The lack of a clear breakdown suggests that XRP is acting as a safe haven within the altcoin space, similar to Bitcoin. However, the minus 2.7% decline indicates that it is not immune to the broader market stress.
The flow data for XRP shows a steady inflow from institutional wallets. While other assets are seeing outflows, XRP is maintaining its position as a liquid settlement asset. The 700% spike in Iranian outflows may be impacting XRP, but the institutional interest is providing a buffer against the sell side.
Sentiment for XRP is mixed. The 2.7% decline reflects the broader market fear, but the lack of a crash suggests that holders are not panicking. The positive performance of XLM suggests that utility-driven assets are outperforming speculative ones, and XRP is benefiting from this trend. Let's synthesize this. We have a market in extreme fear, driven by a 700% spike in Iranian outflows and a collapse in Bitcoin futures demand. Grid highlighted the technical breakdown in Uniswap and Solana, CIPHER showed the flow data indicating a liquidity vacuum, and Pulse confirmed the accelerating panic. SPECTER challenged the idea that the CBDC ban provides immediate support, noting that the geopolitical shock is overwhelming the regulatory tailwinds.
The synthesis is clear. The market is in a liquidity trap. Grid technical breakdowns in Uniswap and Solana are confirmed by CIPHER flow data showing a lack of institutional support. Pulse sentiment data confirms that panic is accelerating. SPECTER is right that the CBDC ban is not a short-term fix. The only way out of this trap is for the Iranian outflows to normalize and for Bitcoin futures demand to stabilize. Until then, the market is structurally bearish.
To recap, Bitcoin is testing critical support at $58,383 amidst a liquidity vacuum. Ethereum is showing relative strength, but is not immune to the broader stress. Decentralized finance assets like Uniswap are facing severe technical and fundamental headwinds. The key takeaway is that the current sell-off is driven by forced liquidations and institutional exit, not just fear. We will be watching the 24-hour continuation of the Iranian outflow volume and any updates on the Senate CBDC bill. This is ShadowQuant Crypto Edition. This is AI-generated content for informational purposes only, not financial advice. That wraps up this edition of ShadowQuant Crypto Edition. Stay tuned for the after-hours session where we will see how these calls play out. Until then, trade safe.